So our cash flows start with our day-to-day business, our buy stuff, sell stuff, cash flows from operations. So it's going to be receipts from customers and payments to suppliers and employees. That's the key components. Then we have investing, and investing sounds weird because normally individuals invest in shares, but this is investing in the infrastructure, the assets of your business. So it's non-current asset purchases, buying property, plants and equipment, or intangibles, or selling them off. Examples, so selling off property, plants and equipment, buying property, plants and equipment, those are the key items there. And then there's financing. So we have to borrow money, or we might raise equity. We might issue shares and gain cash, or we might pay out some dividends. So once again, I've been referring to tech work. So you can see operations, investing, financing. So we need to be able to build this, and it ties in with the balance sheet. So what we do is we get our cash at the beginning in the balance sheet, and then we adjust for operations, investing, and financing, and that will give us our cash at the end. So this is the the low funds example that you get to work on, and I'll show you what we do. We build the template I use is the same as those formulas. I just structure it down the page, so it's quick and easy. Now, when we do cash flow from operations, we need to calculate receipts from customers, then payments to the suppliers and employees, then interest and income tax are separately disclosed to make it easier for the user to interpret. So there's no magic to the template. You can't just memorize it. It's logic. It's based on reconciling T accounts. So don't rush it, practice it, get good at it. So what we do is, step one, we don't know what our cash receipts from customers are, but we do know what our opening balance of trade receivables is. And our trade receivables are like our debtors. So if we have our debtors, I know that we're going to collect that during the period. So cash receipts from customers is going to include all my collections from last period that I'm going to collect in this period. So anything that was left uncollected, I'm going to collect this period. So we get our opening balance of trade debtors. I'm also going to collect most of my sales revenue this period. So I'm going to collect any outstanding debts, that's why we add it, plus my sales revenue. But I'm not going to collect all that sales revenue because there might be some bad debts. And this is why we need to adjust for that. So when a sale happens, debit receivables, credit sales. But if you have a bad debt, you have a doubtful debts expense and an allowance for doubtful debts. Then, when you write it off, you're going to see a reduction in your accounts receivable. Now, normally when accounts receivable goes down, it's because you've collected the cash. But in this case, you haven't received the cash, so we don't want to count that. So we have to calculate our bad debts written off and take that out from the amount of total cash. So the way we do that as a formula, we get our opening balance of doubtful debts, we add our doubtful debts expense, and we subtract our provision for doubtful debts. So that the logic of that is saying, well, we didn't actually get that cash amount. So from there, we take away our closing balance of trade receivables. Why? Because our sales revenue, let's say we sold 100,000 in a year, but at the end of the year, we had $20,000 worth of debtors, our closing balance. Well, that means we didn't collect all of the sales revenue. So we can't count that in our cash receipts from customers. We have to subtract that. So sometimes people memorize this back to front, and that doesn't make any sense. The logic is we add the opening balance because I'm going to collect that, and we subtract the closing balance because I haven't got that cash yet. And that is how you build cash receipts from customers. So that's the very first step. Now, if you're quick at this, you can solve this in about 40 seconds, 50 seconds. So if you get a question in your exam, within 1 minute, you should have the answer right. And now in a CPA exam, you're going to get 42 MCQs, and you have 2 hours to do them. So you've got more than 2 minutes in MCQ. So you should be able to be very quick. But you're going to be given all this information, and if you don't know how to do it quickly, you don't have much chance. So here is a practical example, and it's just gone 9:30, but this is pretty much my final example for the night. So I'll spend another couple of minutes and see if you can build, and it says pause the video, so this is for people who are watching the recording. I'm just going to give you about 30 seconds. I think I actually gave this to you. If you downloaded the task, the pre-work task, you should have already had a look at this. But you should be able to work out cash receipts from customers. Why? We know what our sales are, and we know that what our receivables are, opening and closing. So we've got sales, but we don't always collect those sales because they might be bad debts. Some of it hasn't been collected at the end of the period. That's going to be in the closing receivables amount. And then we have our opening receivables that we're also going to collect. So here's the logic. The very first thing is we have $210,000 from previous period sales that we are going to collect. So 210, that's my starting point. I'm also going to add 920 because I sold that during the period. So 210 plus 920. But at the end of the period, 245,000 of this 920 was not yet collected because it's sitting in debtors. So I have to take that away. Let's see how that looks in a template. Opening balance of trade receivables. I am going to collect this. It's from the sales from last period. Add my sales revenue, 920. Now, luckily in this scenario, it's quite a quick and easy one. There are no doubtful debts or bad debts. And then our closing balance was 245,000. Our cash receipts, and a few people have been typing that, 885,000. Any questions on that? What you can see is, if you know how to use this formula approach, you are going to get the answer right instantly. And if you don't know it, you're going to be really stuck. Choose the answers that end with 0, 0, 0, potentially. So, why does this work? Why does sometimes people go, oh, you've got this magical template, but why? Here's the logic. So when you make sales, you have a credit to revenue and you have a debit to accounts receivable. So this is how much of that accounts receivable is still sitting there at the start of the period. 210,000 of debtors who haven't paid you that will pay you soon. So we can add this to the starting point. Then, during the period, we make another $920,000 worth of sales. So we add these two amounts together, and that gives us total cash to be collected, 1.13 million. Our opening receivables plus our revenues. We should collect 1.13 million, but we don't because we didn't collect it all. There's 245,000 still to collect. So what is the difference between the 1.13 million and the 245 still to collect? That, well, there's no bad debts written off. So what's the difference? What is that? You know, solve for X. It's like an algebra equation. 885,000. So now you've seen how it looks in a ledger, you've seen how it looks in a graph, and you've also seen how it looks in a template.